Hello, this is your daily dose of financial market trends. Iran just threatened nearly 50 vessels in the Strait of Hormuz, potentially disrupting a fifth of global oil supply, while the US and Canada are escalating toward a full-blown trade war. Let's break down what this means for your portfolio. Looking at where we stand heading into today's session, Friday's close had the S&P 500 at 7,674, up 43 basis points. The Nasdaq finished Friday at 26,180, also up 43 basis points, while the Dow posted a stronger gain of nearly 1% to close at 53,277. The VIX ticked up over 5% Friday to just under 16, while the 10-year Treasury yield climbed to 4.74%. Let's dive into what's moving markets today. Nvidia is catching serious attention across multiple data points heading into their earnings report Wednesday. The chip giant is down about 1% recently, but investor interest is running high as the AI semiconductor leader prepares to show whether demand for their data center GPUs is holding up against intensifying competition. This earnings call could set the tone for the entire AI infrastructure trade through year-end, especially with questions swirling about whether European AI spending will keep pace with the US. Broadcom is on the opposite trajectory, up over 1% and generating buzz for similar reasons. They're also reporting earnings this week, and the market is watching closely to see if their custom AI chip business can justify current valuations. There's a growing divide between US and European AI infrastructure investment, and semiconductor companies with diversified exposure stand to benefit if American tech companies continue outspending their European counterparts on next-generation compute capacity. Alphabet saw something unusual happen recently. Mentions across social platforms spiked over 1,000%, while the stock gained more than 1%. The search and cloud giant appears to be benefiting from the broader narrative around extended Federal Reserve policy pause, since stable rates tend to support mega-cap tech valuations. With their dominant position in both search advertising and cloud infrastructure, Google is well-positioned if the economy manages a soft landing without rate cuts forcing a recession scenario. Iran, the AI data center operator, is down nearly 2% and drawing attention ahead of their Wednesday earnings. This smaller player in the infrastructure space gives us insight into whether the AI build-out is translating into profitable operations at the facility level, or if it's still mostly a capital-intensive land grab. Their results could signal whether we're seeing real revenue generation or just speculative infrastructure spending that might not pencil out long-term. Three major macro risks are in play right now that could reshape markets quickly. First, the Iran Strait of Hormuz escalation. Tehran has threatened dozens of vessels transiting this critical choke point amid intensified U.S. sanctions on Iranian oil exports. The bull case, sitting at about 25% probability, is that diplomatic channels successfully de-escalate this, and we get multilateral transit guarantees. If that happens, oil prices would likely drop 8 to 12% as risk premiums evaporate, hurting energy stocks but giving a boost to broader markets on lower input costs. The bear case at 35% probability is far uglier. If Iran actually detains vessels or deploys mines, we could see Brent crude spike above $95 as a fifth of global oil faces disruption, forcing strategic reserve releases and sending broader markets down 5 to 8% on stagflation fears. Second, US-Canada trade war intensification. Canadian leadership is using war rhetoric around trade as businesses on both sides report existential threats from escalating tariffs. The bull scenario at 40% says both sides reach a compromise that rolls back threatened tariffs for sector-specific concessions, which would boost manufacturing and industrial stocks 6 to 9% as supply chain uncertainty fades. The bear case at 45% is that comprehensive tariffs hit automotive, agriculture, and energy sectors, fracturing North American supply chains and increasing production costs 12 to 18%, while markets decline 8 to 12% on margin compression. Third, the Federal Reserve extended pause scenario. Markets increasingly expect both the Fed and Bank of England to hold rates steady despite political pressure for cuts. The bull path at 35% is that upcoming inflation data shows sustained cooling, allowing the Fed to signal early 2027 cuts and sending Treasury yields down 40 to 60 basis points, while tech and AI stocks outperform by 12 to 15%. The bear case at 30% is inflation stays sticky above 3%, forcing the Fed to hold or even hike, pushing long-term yields toward 5% and compressing equity valuations 15 to 20%, especially hitting unprofitable growth names. On the housing front, 30-year mortgage rates hit 6.65% while the market shows serious tension. Housing starts plunged over 13% year over year, but building permits actually rose 3%, creating a massive gap that suggests builders are permitted but too nervous to break ground. With inventory now at 9.3 months, we're in a standoff between stubborn sellers and cautious buyers. For earnings this week, all eyes are on Nvidia Wednesday and Iron Wednesday. Both reports will tell us whether AI infrastructure spending is translating into the kind of results that justify current valuations in this space. Let me leave you with 5 things worth watching. First, energy exposure matters right now. The Strait of Hormuz situation could move oil prices violently in either direction, depending on how diplomacy plays out over the next few weeks. Second, semiconductor earnings this week are a real referendum on AI sustainability. If Nvidia or Broadcom disappoint, expect the entire AI trade to reprice quickly. Third, the US-Canada trade situation is being underpriced by markets. Integrated North American supply chains touching automotive and agriculture could face serious disruption if this escalates further. Fourth, the housing market freeze is creating opportunity. Builders with strong balance sheets and permitted land could be positioned well if rates eventually decline, but near-term pain is likely if this standoff continues. And fifth, the Fed's extended pause is a double-edged sword. Stable rates support current valuations, but if inflation stays elevated and cuts get pushed further out, growth stocks will face increasing pressure. As always, this is educational content, not financial advice. Do your own research and consider your personal situation before making any investment decisions. That's your Morning Market Digest for Monday, August 24th. We'll be back tomorrow morning with another round of What's Moving Markets. Trade safe out there.